Hello and welcome to Unit 5, Stakeholders, Social, Cultural and Relationship KPIs. In this unit, we're going to continue our discussion of connectivity and see how connectivity can be used to contextualize the KPIs that are reported. In this case, we're talking about the connectivity between the content elements, how an integrated report should link an organization's strategy and business model to the external environment and stakeholders. So, an integrated report contains elements of financial reporting, sustainability reporting, but also information about the company's strategy and business model and its stakeholder relations. Stakeholder relationships are important to integrated reporting, and it forms one of their guiding principles. The principle states that an integrated report should provide insight into the nature and quality of an organization's relationship with its key stakeholders, including how and to what extent the organization understands, takes into account, and responds to their legitimate needs and interests. So who are the stakeholders of an organization? Well, there are many. You can have external stakeholders such as suppliers, customers, government, creditors. You can have internal stakeholders such as employees, managers, and owners. These stakeholders' relationship with the company are an important value driver. So if we want to understand the relationships, we can measure the company's social, cultural, and relationship capital. This measures the strength of key relationships between the company and its stakeholders. Key relationships include the customer relationship, strategic relations with service providers and suppliers, positive relations with employees and trade unions, constructive relationships with government and regulators, and of course the social license to operate that the company is granted by the community. Now let's take a look at the types of KPIs that can be used to measure one of these key stakeholder relationships. We can use KPIs to get to know our customers better. It will help us answer questions such as who are they? So we can look at the absolute amount or number of customers, and then we can subdivide this into different categories. We could categorize them as new customers and existing customers and see the percentage of sales that come from each group. This will give us a better insight into who our customers are. Are they recurring customers or one-off customers? We can look at the average revenue per customer and the level of dependence on key customers. We could also look at how do our customers buy the products, or what are the channels. So we could break down our turnover by distribution channel and look at the percentage of sales that come from indirect and direct. We can also look at what and where our customers are buying. So level of customer concentration by sale classes. We can look at level of concentration by customer and geographical area. We can look at customer segmentation by market and territory, or we can also look at the percentage of foreign sales on total sales to give us an idea of how much of our products we sell domestically and how much we sell abroad. We can look at the percentage of sales from new markets, which will give us an indication of how good the company is at entering new markets. Then an important question to answer or to understand is how satisfied our customers are. We can measure this in a number of ways. We can look at a direct measure, ask our customers how satisfied they are. We can also look at the customer loyalty rate, which would be the number of returning customers, or the customers that keep coming back, and the percentage of customers that are loyal. We can also look at the number of complaints per year as another indication of how satisfied our customers are. Finally, we can understand how we communicate with our customers. So what are the communication channels we use, and how much do we spend on communicating with our customers? And again, we can subdivide this into how much we spend on talking to our existing customers and how much we spend talking to our new customers or trying to market to new customers. Social and relationship capital is broad as it relates to key stakeholder relationships and the trust and willingness to engage that an organization has developed and strives to build and protect with external stakeholders. As the number of stakeholders a company can have is quite broad, so are the measures that can be used to measure it. Which ones should we measure? Well, that depends on which stakeholders are material to the business. These can be related to their impact materiality or their financial materiality. In the chart above, I have placed a number of KPIs that can be used for different types of stakeholders. We can see that we can also measure these as inputs, outputs, and outcomes of the business. We can measure lagging indicators and leading indicators. One method to increase the connectivity of your reporting and to contextualize the KPIs is to use a connectivity matrix which places the KPIs in the organization's value creation process, connecting all the different content elements. It starts with the identification of the company's stakeholders, then identifies which matters are material to them, and the risks that could prevent the company from performing well on these aspects. Then it identifies the company's strategic objectives and the drivers that will help them achieve these objectives. Next, you have the KPIs. Here you see that the KPIs are used to monitor progress towards a specific strategy that is connected to a specific stakeholder group and a specific set of material aspects. The next thing is the targets. So this is the future outlook of the company with goals to achieve the strategy. So these are very connected to the KPIs. This is the target level of KPI that the company wants to achieve. And finally, we have the impact, which is the final outcome of the whole strategic process. Here we can see that the connectivity matrix helps us to contextualize the KPIs within the broader business model and strategy of the business. This can be also useful to provide a storyline when writing your integrated report, because it does a great job of connecting all these different content elements. The matrix enables you to gain a better understanding of the connectivities and interdependencies in an organization. To enable better informed decision-making, the matrix can be operationalized into an integrated set of management information embedded in a reporting tool, i.e. an integrated dashboard. This can help firms to manage their impact by evaluating them systematically. Thank you for your time and attention, and I'll see you in the next unit.